Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the investment information you need for your portfolio. Today, I'm joined as always by Sydnee Freed, my sidekick, and today we have Michael Gayed. He is the publisher of the Lead Lag Report, also a CFA. Welcome, guys. And on the docket today, we are going to be talking about the growing corporate risk in America, maybe an underappreciated risk. And our word of the day is concentration. Is it truly a risk? Spoiler alert, yes, it still is. And this episode brought to you by the number 81. That's how many days we have until Americans elect the next president. How much does it really matter to investors? Well, week two of the saga that began with the VIX hitting the mid-60s last week in the middle of a bull market, Japan blowing up in a big way, spilling overseas. How are you seeing the market today? This is about a week later.
Was that really like last week?
You know, it seems like ancient history.
Seriously, that seems ago. It's like I feel like everybody forgot about that because everyone suddenly bulled up again. This is what happens when everybody's on the same side of the boat holding an anvil.
Yes.
All right. Everyone's basically bullish and of the same mindset as far as things will keep on rising and rising just because they already have. I've been highlighting this reverse carry trade idea since August of last year, which I know it sounds complicated, but the idea is very simple. Japan is, there's a monetary mismatch that's happened. Every other central bank has raised their rates except Japan's because they've never had to really deal with inflation. Here comes inflation. Now they're way behind the curve. Meanwhile, if you want to borrow money really cheaply, you don't need to do it by borrowing in the U.S. You can borrow from Japan because at zero rates, why not? So if everybody does that, everybody leverages their portfolio based on Japan as the enabler of that leverage. If Japan then starts to raise rates, that creates a problem for you as the borrower, because now you're having to pay back that loan with a stronger yen as a result of that, and that creates volatility and, you know, conceivably a global margin call. Now, you had a moment there when everyone freaked out. My own X account at Lead Lag Report got 14 million impressions because everyone knew I was the guy that
I got to say, you were blowing up. I follow your account as I have, and there was a lot going on.
It was a lot, yeah. It was, and I put a whole video out this on Sunday, basically, even showing that, which had 200,000 views, at least as we're chatting here. I don't think it's over. I think when these things take place, it takes time to work its way through the system. The carry trade is something that's been ongoing for years. You don't resolve that in 48 hours.
Yeah, we're going to let's circle back to the carry trade. I want to get to our word of the day, which is concentration, because it kind of relates to everything we're talking about. Market concentration can occur when only a few stocks in an index or portfolio account for most of the gains. Bull markets experience some degree of concentration in indices as some individual stocks rise in price, they rise in market cap, and therefore they make up a larger part of the indices, the pie. And the dynamic also works with individual investor portfolios. And we talk a lot about concentration this year in the form of the Mag 7, but it applies to a lot of different pockets of the market. I'm just wondering where you see it right now and where the risks lie.
It's actually, I think, a really interesting time in history in that it's debatable as to whether the S&P 500 is really a diversified index anymore, right? When you've got a select number of stocks that are driving the entire momentum play across the board. The reality is most stocks are still trading below their 2021 highs. So it looks like a bull market, but it looks like a bull market because it's really a concentration bubble where you have some of these large cap tech names driving pretty much the entire performance. That's worked if you're an index investor, obviously. The problem and the risk there is that now you're not playing the market, you're playing individual companies, right? And that concentration risk means you have much more what's called idiosyncratic, company-specific risk, which could become problematic, right? I mean, lay out any scenario. China invades Taiwan. What happens to NVIDIA and what happens to the semiconductor trade? Maybe NVIDIA actually goes up more, right? And becomes even more concentrated as a result, right? It could be because now they're the only ones left standing. But the point is that it's not a good thing when you're at a point where a rising tide is not lifting old boats. I've used that line before on X. When a rising tide does not lift all boats, everybody drowns. There's always an aspect of the Pareto Principle, 80-20, driving returns, a small number of things. But you're at a point where it's like the Pareto of the Pareto. It's like the 80-20 within the 80-20. Yeah. And I think that's not a healthy thing. I also think it's somewhat reflective of the economy, right? You only have a small number of participants generating all the wealth. Everybody else is still feeling like it's a recession. it's a microcosm of a much bigger issue.
Michael, did you say the word Pareto?
Yes.
That went right over my head. Can you explain what that is?
The 80-20 rule, it comes from this guy, I forget his name, but it's something Pareto.
Mm-hmm.
But basically, it had to do with the potato famine, as I recall.
Not what I expected.
No. But basically, it is that 80% of your returns come from 20% of whatever your mix of things is. So a small number of things are the explanatory variables, right, that go into an outcome. And you see that in a lot of things. There's always a small number of things that have outsized returns. But the smaller that number gets, the more fragility there is.
So going back to something you said there's debate about whether the S&P is diversified.
Yep.
So if you are an index-only investor, how can you further diversify away from those?
Good question.
Yeah. So the question is, what is it about the S&P, which you can argue is a feature, not a bug, which is that it allows for this concentration, is that this is a market cap weighted average, right? So in other words, the biggest stocks get the biggest weighting in the average. There are a lot of ways to resolve that by looking at other types of indices which might be equal weighted, right? Where you're spreading out the risk across more stocks evenly as opposed to just favoring the largest of the large. You can also tilt smaller mid-caps, small caps. I do think there's a lot of opportunity in a large part of the marketplace which has lagged throughout the last 3 years.
Which is?
Primarily small caps and mid-caps. Small caps, there's
let's talk about small caps here.
So I've said repeatedly on X, small caps hold the key because part of the reason why I've been skeptical of this so-called bull market is the vast majority of stocks are trading below their 2021 highs because there's concern that these companies will no longer make it. Mm-hmm. There's the so-called zombie companies. They have very high leverage, razor-thin margins, and now they have to roll over their debt into much higher rates, right? Even if the Fed cuts rates by 25 basis points, 50 basis points, it's not enough.
They almost need a recession, in which case they might go under anyway.
Right, exactly. Right, so they might go bankrupt, but at least they have a chance because rates might be lower enough at that point for them to survive. That's exactly right. But because of that, you can argue that there's this overreaction in terms of pessimism on the small cap side and overreaction in terms of optimism on the large cap side, the market cap weighted side. So the best way to diversify away from the S&P is either equal weight or do something much smaller in terms of your average, which of course means have more stocks. The problem is you do that, and guess what? You're not going to be that happy with the results because it sucked the last 3 years.
Yeah. So let's dig into some of the catalysts that we might see. We have CPI coming up. When we release this, it will actually be one day in the rearview mirror. But nevertheless, let's talk about what can move this market. And CPI, I look at reports, how much they affect the benchmark indices, and it is by far and away a much bigger mover of the market than the Fed or non-farm payrolls. What do you think is going to happen? What could happen?
It's very tricky, I think, when you look at inflation. So there's an argument to be made that inflation largely is squashed in everything except the stuff that matters, okay? Which is always the case, but
food,
maybe
energy,
the
shelter,
the stuff that nobody
education,
needs,
medical.
Right? If you're fasting, you don't have to worry about that. That's why I don't feel inflation anymore. But I think it's. So I have this sort of theme of mine, which is I think there are three sources of inflation post-COVID. Initially, it was the supply chain side of things, right? So we know the disruptions, everything got priced up because of that. Then it was the stimulus consumer spending. I think the other wave of inflation, which is still there, but primarily centered around the very wealthy, is asset inflation, right? Which is the stock market and housing. So the wealth effect, right? So to the extent that the S&P 500 and housing stay elevated, and the very wealthy see that and that makes them comfortable to keep on spending at the rate they've been spending, there's still going to be inflation. Mm-hmm. It's very high wealth, consumer-driven inflation. To the extent the S&P drops 15-20% and housing drops 15-20%, yeah, you're probably going to have a disinflation, deflation scare. But my point is that any sort of CPI number here that might come in a little bit hotter than expected is probably more because of asset prices, not because of something is due to the Fed's lowering of rates or raising of rates.
Sid?
Yeah, I just have a question generally about when econ data comes out and stocks move one way or another. Like, basically, why does it move? Like, even when we got that weaker than expected jobs report, stocks tanked. There was also the yen carry trade. But then when we got the next data point and it wasn't, everything kind of reversed. Yeah. So how much can investors really rely on these data points? Or is it more that we should be watching general trends in the market as opposed to what inflation is telling us, what the latest jobs report is telling us?
The reality is most of the reactions have nothing to do with human beings. It's entirely machines and algos that are trading off of each other, off of headlines, because there's no way anybody can possibly read a CPI report, click a button that quickly, do it in size, and then move markets. It's all obviously very much driven by algorithmic, high frequency type of dynamics, which can be noise and can be gaming each other. It's machines fighting machines. So I don't know if there's much signal in that, right?
There's a great graphic that's about to pop up here.
I'm sure, yeah. It's going to be Terminator type style, right?
So I genuinely am curious about that. Is that how it works? Like, you get a print. Are there not just a bunch of individual investors all of a sudden selling stuff because it came in weaker than expected? Is that not how it works?
If they are, they're already way too late. I mean, I think that's the point. You're talking about milliseconds.
Yes.
Yes. Markets are supposed to be efficient because of the speed aspect, but not efficient to the point where it's like half a millisecond, right, where the price reacts that way. Because there needs to be an actual processing of the information to determine what trade you want to make.
The way I've always seen these reports is it gives the market an excuse to move into an area where there's going to be a large investor that makes a decision. You're just trying to go from equilibrium point to equilibrium point, and you're absolutely right. That doesn't happen in half a second. But I look at the close, like if you have a big payroll report that day, or if you have a big CPI report, where did we close? Was it good news being good news, or was it good news being bad news? And that, I think, kind of informs my own personal, direction bias. All right. We got to hold this thought for a second. And coming up, we're going to be talking about the presidential election and the outlook for stocks, plus an international edition of Who Wore It Better. Break out your sombreros and didgedoos. All right, we are back in this episode brought to you by the number 81. That is how many days we got until Americans press the mechanical and virtual levers for the next president. We talked last week with Ryan Dietrich about seasonality in these years, election years, but we've also cataloged on this program just how wrong the investing predictions were for Trump and for Biden, with the legacy energy versus clean energy trade 180 degrees what investor consensus actually thought. Then again, consensus is also usually wrong. So how do you see the election unfolding, and how much do you care who actually wins in November?
For markets, it can matter from a historical perspective in the sense that typically the market does better under a Democrat than a Republican, which is surprising to a lot of people because you'd think that Republicans would be more favorable for the stock market because of tax policy and pro-business. Part of that's maybe skewed by the 90s, right, to some extent. There is another implication in terms of who wins in terms of sector leadership. So typically when you have a Democrat in office, technology outperforms. Typically when you have a Republican in office, technology underperforms relative to other sectors. And Republicans tend to have the most impact on the raw materials sector, energy materials. The one thing that I think everybody can agree on, independent of your politics, is whether it's Trump or Harris or Kennedy or somebody that had parents that came from Mars and that alien is born in the U.S. and can then run for president, the commonalities remains the same. They're all going to add more debt to the system. Let's call a spade a spade. It's where they're going to direct it. It's a whole different issue, right? That matters so much more than anything else, given that we have, $35 trillion of government debt now?
About.
And yeah, roughly, right. I mean, in reality, it's much more than that when you factor in the unfunded liabilities. That, to me, is the more stressful thing, I think, to think through. I put a poll out on X asking who would add more debt to the system, Trump or Harris?
And what'd you find?
The interesting thing was 70% said Harris, which was actually fascinating to me because I think it would be more Trump, honestly.
Why do you think that was the response?
I think I think it's partly justified. There's a communication issue on the Democrat side that everyone thinks that they just spent.
Yeah, but it doesn't really matter. Like, is it like, one of them will add 500 billion versus 450 billion? Like, is it kind of like that?
It doesn't. Yeah, I think that's right. I mean, in reality, these are rounding numbers, right, for most of the things. But it goes back to you're never going to have somebody in office who will enact austerity, who will actually cut back on spending because you don't get elected.
They'd have to get elected on that mandate,
good luck.
And that's very unusual.
Right, good luck. I mean, that's never going to happen.
Is there a correlation between like a clean sweep, say Democrats or Republicans get everything, the White House, Congress? Is there a correlation with how stocks do, or is it just the president under Democrats, the stock market does better?
Yeah, from what I've seen, it tends to be more on the president's side, not the clean sweep side. And that's kind of a relatively small sample on the clean sweep side, so kind of make, I think, broad generalizations. But the point remains the same. Everyone gets hyped about who's going to be president. Is it going to be good for the stock market or not? The reality is, for the most part, even though you will have a president claiming that they are the reason why stocks did this or that, the reality is it has less to do with the present, more to do with monetary policy and optimism.
You're an ETF manager. I want to ask you about some of the ETFs that you manage, and one in particular, JoJo, that's JOJO, you believe is ripe for a breakout. Can you tell me, it's really interesting to me how these apply to risk-on, risk-off scenarios and how you would use them in conjunction with each other.
What is the risk that's off in the term risk off? Nobody ever defines what because there's still risk in everything, right? The risk that's off is default risk, bankruptcy risk, right? It's why when you have a more traditional recession and high volatility juncture, credit spreads widen because the bond market starts getting nervous about some highly levered company being able to survive, right? Okay. You haven't had default risk in a long time, right?
Yeah, GFC maybe.
Yeah, GFC, and then you have some momentary scares, but we just went through the fastest rate hike cycle in history. Bonds got crushed, but they got crushed because of interest rate movement, not because of default risk, not because of a reevaluation of credit risk. And the name of that fund is the ATAC Credit Rotation ETF. I designed it for credit risk widening. And I happened to launch it right in the middle of 2021, before the bond bear market really started picking up steam and before the duration crisis.
I've seen that happen with just about every ETF.
My timing has sucked on launching funds. It's very clear between my RORO ETF, JoJo ETF.
Well, you're subject to the whims of the SEC too. It takes a while to get these things through.
Yeah, and also, correct. And also, it's one of those things where if you're going to try to stand out against Vanguard and BlackRock and all these other very large companies, you've got to develop a different type of product, right? This is from a business perspective. In my case, I need a very particular cycle. I need a cycle where there's risk. And when I go back to risk off, I need a cycle where there's default risk. So I would not mind seeing a recession. I would not mind seeing default risk rising, which is more normal than what we've seen the last 3 years. And if that's the case, then hopefully my funds have a chance because I need the environment to favor them for them to stand out.
Michael, going back to our diversification question, in terms of you said JoJo, it's a bond ETF. How much do you think should be correlated in an average investor's portfolio, stocks to bonds, maybe a couple alternative assets in there?
So I'll flip the question a little bit, and I'll say, as a general rule of thumb, the definition of diversification is you have things in your portfolio that you hate. You have to have things in your portfolio that you hate, because if you hate your
they usually have the lowest prices.
Yeah, right. Well, exactly right. Because why do you hate them? Because they're not performing. I mean, diversification has to mean if everything's firing off in your portfolio, you're clearly not diversified.
We got to redo the definition of diversification.
It's not,
we have an entire green screen.
Yeah,
no, right. Put hatred right on the screen. But I think that's the point. It's like you have to have things that you don't like because they're not performing to be diversified. Now, how you weight them is a whole different issue. I get that, right? But broadly speaking, going back to the concentration bubble in the S&P 500, you're definitely not diversified in that one proxy for, in quotes, the market. Most people still hate bonds. They probably shouldn't, because the time to buy something is when everybody hates it, and everybody still hates bonds. Alternatives do make sense broadly as diversifiers, gold in particular among them, because it's not correlated over time. I think that's why it's doing quite well. There is a demand out there for non-correlation. And the thing about diversification, true diversification, is you're going to have years where you're doing okay and years where you're doing okay, meaning you're never going to be exceptional and you're never going to be collapsing. And that's okay.
With that, we're going to start in today's Who Wore It Better? And we're venturing beyond the borders of Hollywood, a bit south to the land of Mexico, where we find the Mexican peso recovering from a beating, down 25% since rebounding 10%. That was 1/4 of its value wiped out in weeks, a huge amount in Forex land. Then we cross the equator, travel halfway around the world, and land in Australia, where the Aussie dollar has been roughed up, down nearly 18%, then whipsawing 9%. It's not just how big the numbers are. Who is wearing the yen beating better among some of these higher yielding emerging market economies?
It's a very good question, and I don't know if I'm not big on fashion, as you can tell. Right? So I don't know if I can answer who wore it better. But I think what you're hitting on is something which is important. Healthy global systems do not have volatility like this. In Forex, in currencies, where people forget it's not just about the Aussie dollar and the yen. This is what people use to transact
Multinational
globally.
Corporations use this. I mean, this disrupts their planning efforts in a big way.
How can you possibly know how to hedge or how to think through your revenue if you're an exporter if in a single day you can have a disruption like that? Think about how that reverberates over time in the actual fundamentals of every single company that's out there. That's why I keep going back to none of this can possibly be over. because we haven't seen the butterfly flapping its wings ultimately creating the hurricane. It takes multiple rounds of that to filter through in a chaotic system. So, listen, I mean, it's true that stability tends to breed instability. I think we're at the very start of that birthing process.
At the end of the month, I wouldn't be surprised to learn of a broker kind of scrambling for credit. Depends on how things evolve. But
I have no doubt. This is what you see, actually, is you end up not hearing it as it's happening, but there's probably some firms that largely have blown up.
It took a few weeks for Melvin Capital to make
Right,
this.
exactly right. And it goes back to there's always lags with this stuff.
I have a very basic Forex question for the
this.
two of you. Currency. You know how you say like the dollar is up against the yen? Could you ever say the yen is blank against the dollar? Like, how do you flip these things?
Because of the convention.
Yeah.
Which is first? I mean, that goes back to the 1970s. I don't know if you have thoughts on this, but basically that's the way it's been done for a long period of time. And you look at the order, it's the euro versus the dollar, not the other way around. But it used to be the Deutschmark versus the dollar.
Right.
Your thoughts?
Yeah, I mean, part of that's just, I think, reserve currency and us being egotistical Americans.
That's what I was thinking. U.S. has to come first.
Right.
Well, we want to get a little personal.
Yes, we do.
So you are a musician.
Yeah.
I want you to talk a little bit about that and how it compares to working in the stock market a little bit. It doesn't at all.
Recording a studio album.
It's funny. I was actually just interviewing a guy who, in the 80s, was part of a pretty big band. And I asked him that question. I said, as a musician, I forget who said it. I think it was Stevie Wonder who said it. He said, there's only been one song ever written, and every single musician has their antennas up picking up just a piece of it. I think that's kind of roughly the quote. And the point of that quote is that everything has a progression and is fairly repeatable. And you can make the case that is the case with markets as well. There are cycles, there are progressions that take place, which they sound similar to prior songs and they rhyme. They're not exactly the prior song, right? I started being a musician in college with guitar because, like every other young man at the time, I was trying to impress ladies. Clearly, that did not work. And wrote a few songs, put an album out in 2020, 2021. It's more of a
You did that in the middle of a pandemic. I mean, were you even allowed to be inside and congregate at that point?
So it was interesting. I had a bunch of songs I had written, and I still had the original WAV files, which sound absolutely horrible. I hope to God they're never released. But I had a producer, right, that I found from a website, and hired a bunch of session musicians, and here we are. I use them instead of other music because I don't have to pay licensing fees for my shows.
Fun fact, you lost nearly 100 pounds.
I know, well, and
You lost 100 years.
Wow, there's a
Like Benjamin
Freudian
Button.
slip.
Yeah.
All right, Britt Van Winkle here. What is it? All right, you lost 100 pounds over a year by fasting and through exercise. Tell us about that experience.
I turned the page on my life because I started saying to myself, if I don't do it here, I'm not going to do it later.
Sure.
It's funny because I think where it really started, as I recall, was I started seeing ads for intermittent fasting randomly on X, and then I started getting YouTube algo pushes. I started watching them. It's like, all right, this kind of makes sense. My brain tends to operate in very much a to-do list type fashion. So it's like, all right, if I'm going to fast, it means I have one meal a day. Okay, check mark. Now I'm done. I can do other things. Started getting into the science of autophagy. Started learning about supplementation. Basically, started targeting every single week. I need to lose 2 to 3 pounds. I don't deny myself when I eat. The fascinating thing about fasting is that you can actually eat whatever you want.
No, I didn't know that.
But you end up naturally favoring higher protein because you realize how much more protein you need when you're fasting. But it's been funny because I never intended for it to be a thing on social media, but as I've been sharing it, so many people are now saying, you've inspired me to fast, and then I joke that the stock market's going to go through its own fast, as if I'm right about this carry trade. But some people think it's a fad. And I go back to, if you think it's a fad, please say that to Jesus Christ.
All right, good point there. And we got to leave it there. We have wound things down. And thank you for joining us. Michael, as always, Sid, we're going to leave it there.